Today, folks, we're diving down into my $282,000 dividend stock portfolio, but I'm going to do something no other stock investing YouTuber is doing, or even day traders for that matter. I'm going to compare the performance of all of my investment accounts over the last several years to the S&P 500 and the NASDAQ 100, because those are the benchmarks. If you ain't keeping up with those, your strategy sucks. I'm sorry. This is why I'm trying to be as transparent as possible. So I'm even going to share with you the stocks I bought this week, how I'm managing these accounts, and what I plan on doing with them in the coming year. So in the clarity of my transparency and all the wonderful homework I present to you today, because this is a lot of information most people won't share with you, consider hitting that like button, folks. And let's kick it off by first of all just talking about performance metrics, and then we'll get a little bit more in depth. I wrote these down to come out and just have this wonderful conversation with you guys. So just to kick this off, currently guys, let's throw this up on the screen because these are all three of my major accounts. This makes up for about 240,000 of the entire portfolio, and you're going to see up there's a blue line. That blue line that's kind of hidden in the middle there with the dotted line below it, that dotted line is going to be our benchmark. That is the performance of the S&P 500, and the blue line is my TFSA, guys. It is currently up 143% since inception, with a performance of outperforming the S&P 500 by 44%. So that account is probably my largest account. It's worth about $140,000. So it's getting closer to meeting and matching the performance of the S&P, but that's probably because primarily it is a dividend portfolio, which many of you know. My tax-free savings account holds things like Apple, Microsoft, a lot of the Canadian banks, a few utilities, guys, some REITs in there as well. It's just a relatively boring account, but I love it because it generates a really healthy about $5,000 to $6,000 worth of dividends annually. That is roughly 100% tax-free. Favorite account of all. I know, broken record repeating that one. Let's talk about the RRSP, which is the black line. Now, I got lucky with this account because this is where I ended up buying Tesla, and we can see, guys, that the account is currently up 239%, outperforming the S&P by 129%. But again, much smaller account, but still not complaining. The account's worth over $40,000. I think closer to $50,000 at this point. And in there, obviously, right now, I've just got stabilizers. I got things like Johnson & Johnson. I got my Lockheed Martin for my aerospace, and obviously some of my Kimberly-Clarks and Pepsis, right? Just some of those consumer staples. And then my final account, which is my oldest account, my cash managed account, which is just a non-tax advantage, a regular brokerage account here in Canada that I'm using with Scotiabank. And that account, surprisingly enough, the oldest account, is up 357%. My goodness. Outperforming the S&P 500 by 247%. And I don't actually know how well that count is done or what it's produced, because I throw money in and out of there, because obviously on the annual additions to my tax advantage accounts, I'll just pull it out of that account. So that account has been drained a couple times, and I've shifted money around here and there. I would love to update you on my corporate account, but I am so confused and still trying to figure a lot of that side of it out. Right now, the corporate account contains something like $27,000, and that's not talking about my emergency fund, which we're going to get into in a second as well. But I will have to figure out how to get all the performance metrics for that in the coming months, as that account only just started, and it's likely that I'm underperforming because I was holding Tesla in there that I rebought back at a discounted price, but obviously it dropped a little bit more from the buy price that I started with at like $670 or $630 or something like that. But nonetheless, folks, you might be asking yourself a question kind of looking at these lines, and you might be like, how are these accounts so stable? I mean, I imagine a lot of people are seeing an extreme amount of volatility in their accounts, and month over month, my accounts are either flat or trending to the upside. And I kind of want to explain this in a way that I mitigate a lot of my risk by taking profits. And this is something that I think too many people lack the emotional tolerance to do when they get caught up in the gleam eye of capital gains all on paper, and they see a $50,000 or $20,000 gain, and they're like, oh, I'm just going to let it ride. And then you're in things like AMC or GME, and you just don't know what the future is going to look like, and you don't understand that one position now maybe makes up half your portfolio, which is insane. Like, it's the same thing I did with MindMed, right? Like, when these small cap companies, guys, that you hold, or any of these high growth companies just explode and they become a large percentage, I'm going to say more than 10% of your portfolio, you need to severely start considering to take some profit off the table. You have to understand that that money is still going to perpetuate income, dividends, capital gains. You just need to put it somewhere where it's going to be a little more sustainable and reliable in case those things blow up in your face, because that's why you see people's accounts with charts that look like, you know, a wave pool, because they don't understand what they're doing when they're buying some of these riskier investments, in my humble opinion here, folks. Now, look, guys, before we get into the stocks that I bought, I have to say the scale of my portfolio at this point has been unimaginable to me. I mean, we're about to cross 300K when last March into 2020, my portfolio dropped dropped almost to 100,000. So this is at a scale that I didn't think was going to come as quick as it did. I'm grateful. I hope a lot of people are experiencing something similar, but I've come to this realization at this point that I want a lot less risk in my portfolio unless something really tickles my fancy. But for the time being, guys, I'm focusing on relatively just safe investments. And the reason that I'm doing that is not only is it the path of least resistance to wealth, guys, at this scale, it's like, I don't need to be chasing the risk of trying to get a 50 or 100% gain when, you know, I could risk losing a huge percentage of that money in the near term when I could just be buying index funds or just be buying safe investments like banks or like utilities or like some of the big tech giants, because those things, if I can even get a 10% return on the 300K portfolio, that's $30,000 a year. And I think I'm still going to do better than that. I mean, my portfolio is averaging like a 28 to 30% a year. And though I've taken a little bit of risk off the table, I still think we're going to do well. So let's talk about what I've added to my portfolio. And the first thing isn't a stock. In fact, it is an emergency fund, which is something I've never had ever. And I learned this last March when my career went belly up and I saw $15,000 worth of my contracts drop and my portfolio dropped 30%. I don't want to draw against my portfolio. This is also one of the primary reasons that I have dividend stocks to kind of supplement that income for horrible incidences like that where I don't get unemployment benefits because God forbid I was self-employed. But, you know, at least things worked out pretty well. But that kind of slapped me silly and said, hey, Kyle, like, what's wrong with you? Like, you need to make sure you have at least 6 months worth of your expenses. And what if the market crashes again? I didn't have any real capital to leverage in heavily, but now I've been deciding to take 5% of my portfolio at all times as an emergency fund. And luckily at this scale, it actually makes up a full 6 months of my expenses. So I added $15,000 in cash to the portfolio after tax. That's just going to be sitting there as a mitigation for whatever incidents may come in the future. I'm always going to try and keep that at a 5% weighting. So as the portfolio scales over time, so shall the emergency fund. Now, after the emergency fund this week, I added Algonquin Power. This is a Canadian company that primarily operates out of the US, doing renewables, transmission lines. It is like an ETF of utilities, and it was trading down 16%. It pays a 3.6% yield. For some reason, Google and my account say it was a 4%, but they're lying. Some guy in our chat group pointed that out. I was an idiot. I still love the stock, however, so I decided to pick up about $5,000 worth of that. I will be scaling that to about a $10,000 position. And these are my boring plays, the stocks that I love, guys, because they're just basically paying the bills, being sustainable, not only providing capital gains, but a really healthy, growing, compounding dividend yield for that passive income. So I think Algonquin's doubled their dividend every 10 years. So hopefully in the next 10 years, it'll go from a 3.6% yield to over a 7% yield, because that would be super awesome. Now, putting that aside, guys, the next two stocks I will be adding with Algonquin Power, Google, baby, and Amazon, baby. I've come to realize that as much of a dividend investor as I am, you got to realize that sometimes, guys, you need to go where the future is. And it's not hard to recognize the future with companies like Amazon and Google. And I also want to own all the companies that are dealing with AI. I have learned the power of AI from every industry, and I just don't think people appreciate the disruption that is going to create. To give you a really simple example, Boeing was designing plane parts, and they took the CAD program and they said, hey, we want the structure of this plane to basically be as light as possible, but as strong as possible with the materials. What design or shape is going to give us the strongest outcome? Well, they feed it to a machine learning algorithm, and it goes through thousands of different examples to see what's going to have the best strength with the least amount of material, and then it craps out of design. And that's just one example, guys, and I just don't think people see how this implements into every industry. And there are only like 8 companies dealing with AI. I mean, you got Tesla, Apple, Microsoft, basically all the big guys. That's it. And that's like Mark Cuban says, guys, you want to be in the future, there's only going to be the AI haves and the have-nots, and you want to make sure you have the have. So I'm going to be adding those to about a $10,000 position each, and then I'm going to own what I call my favorite stocks of all time, which is all the tech giants, guys, which is, again, Apple, Microsoft, Amazon, Google, Facebook, and Tesla. And then I'll be done with those being the primary. Holy geez, the flies are right out here. Now, this might not happen overnight. It might take a few months to scale Amazon, scale Google, guys, and finish off my Algonquin Power. And then finally, what I'm going to do once that is concrete, I want to get my dividends from where they currently sit, which is about $8,300, I think, to try and get them to over $10,000 a year in annual income. And a lot of people said, hey, Kyle, your portfolio isn't yielding that much. Like, why is your yield so low? And it's because, hey, I'm not chasing high yield, guys. I'm chasing security and capital, like dividend growth, because I don't necessarily need those dividends. So if they can compound for the next 5 to 10 years while I keep working on things, I mean, hopefully if the compound interest takes effect, a lot of these dividend yields will likely double just based on the way these companies deal with their dividends, right? Which would be super grateful, because my FIRE journey, I want to experience sometime between 35 and 40, but let's bring it back to scale here, because just projecting out in the next year, once I basically got those few positions rounded off, I have been making a list of a little bit higher yielding dividend stocks in the real estate sector and some other positions, because while I'm still in my 20s, I want to just scale that dividend yield to get it between 10 to 12,000. I've got my growth where I want it, and then I am stepping back from the portfolio in general, guys, because what I'm going to do is basically just allocate half my funds to more dividend stocks, maybe keep adding little bits to the positions I already own. Well, I take the other half and start adding index funds to my portfolio. Index funds are something I've been playing around with, and I just kind of always sell out of them because I keep saying, well, if I keep outperforming the index, why am I chasing the index, right? And we all know it's to mitigate security, because a lot of people think even buying individual stocks is insane. But because of my age, I think it's the most appropriate way to allocate the risk. So as soon as I hit my 30s, which is coming in the next 12 months here, guys, I really want to get this portfolio rounded off and then just say, hey, you know what? In my 30s, for the next 5-10 years, I'm just going to focus on my work, scaling my business out while adding a couple positions, maybe a month at most. I do not want to be doing the day trading I'm doing, because it's a technical tax nightmare that I'm finding already for my accounts. It's why I haven't updated you guys personally on my income and expenses. I started a 6-figure challenge to see if I can make 6 figures this year. Looks like that's not going to be a problem, graciously, as I made this really crazy transition since I lost my career of being a full-time performer. So I'm just trying to balance this stuff out, and then I'm going to give you guys some full insights on how my business is actually performing, because like I said, it's been really great, and I love giving you guys the transparency as I kind of grow with you. So in light of that, I pass the question off to you guys. What do you think about all this in that comment section below? And I look forward to catching you real soon. So stay cool, stay awesome, and I look forward to catching you at least tomorrow.